Health insurance, meaning, types, underwriting and benefits. The Solomon Fadun, Risk Management of Everything channel, presents health insurance, meaning, types, underwriting, and benefits. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to notify you when we upload new videos. Thank you. This video discusses health insurance, its meaning, types, underwriting and benefits. In this video, you will understand the meaning of health insurance, the importance of having a health insurance policy, contributions of health insurance to your well-being, factors to consider in choosing a health insurance plan, health insurance underwriting factors, types of health insurance policies, limited health insurance policies, health insurance plans and systems, healthcare plan systems, categories of health insurance plans, utilization of healthcare services. Medical underwriting in health insurance, how medical underwriting works, types of medical underwriting, limitations of medical underwriting, alternatives to medical underwriting, health insurance underwriting decisions, differences between life insurance and health insurance, differences between health insurance and medical insurance, factors to look for in health insurance terms and conditions, copayment clauses, waiting periods, standard exclusions of health insurance policies, things to avoid while buying a health insurance policy, and national health insurance. Now, let us start. In its broadest sense, health is a state of complete physical, mental, and social well-being. It is not just the absence of disease or infirmity but a dynamic and multifaceted concept encompassing our physical, emotional, and social capacities. Health insurance. Health insurance is a financial safety net that helps manage the costs associated with healthcare. It covers medical expenses incurred due to illness, injury, or disability. Health insurance policy covers the medical and surgical expenses of an insured person. A health insurance policy is an assurance that provides immediate financial help in case a medical emergency arises. It is a contract between a policyholder and the insurance company that covers medical expenses due to illness, injury or accident. Suppose a person purchases a health insurance policy. In that case, the insurance company will bear all or some of the medical costs the insured should pay. Healthcare expenses are increasing at a rate higher than medical inflation, which is why it is suitable for everyone to have health insurance coverage, which helps save emergency funds and reduces medical costs. There are two ways by which the insurance company compensate the insured for medical expenses: cashless treatment and reimbursement. Cashless treatment, the insurance company pays the hospital directly. The policyholder is not involved when paying the health insurance hospitals. Reimbursement, the policyholder is supposed to settle their medical expenses first and later ask for reimbursement from the insurance company. Importance of having a health insurance policy. Health insurance policy should be a part of a person's financial planning. Investing in a health insurance plan at an early age has several advantages, including better sum insurance coverage, lower premium rates, and no medical examination. Purchasing a health insurance plan is something that we all avoid until we understand its importance. Before buying one, it is crucial to understand the various benefits of a health insurance plan. Purchasing a health insurance policy at a very young age, where one can have comprehensive coverage at an affordable premium cost, is advisable to get the advantage of tax deductions on the premium paid. Here are some benefits of purchasing a health insurance policy. 1. It facilitates superior medical treatment without worrying about high medical costs. 2. Offers specialized coverage for critical illnesses. 3. Offers an affordable premium for youngsters. 4. It provides cashless claim benefits, allowing people to care for their health instead of worrying about hefty medical bills. 5. Protect savings during medical emergencies. 6. Provides tax benefits and tax holidays in some cases. 7. Safeguards the assured and the family. 8. It provides life protection and improves savings habits. Contributions of health insurance to your well-being. Here is how health insurance can contribute to your overall well-being. 1. Access to preventive care. Health insurance often covers preventive services like checkups, screenings, and immunizations. These proactive measures can help identify health risks early on, preventing future complications and promoting overall health. A routine blood test covered by the insurance might reveal high cholesterol levels, prompting the insured to adopt healthier lifestyle choices to manage it before it develops into a more severe condition. 2. Financial security. Unexpected medical bills can be a significant financial burden. Health insurance helps mitigate this risk by sharing the cost of healthcare services. This economic security can reduce stress and anxiety, contributing to mental and emotional well-being. A sudden accident requiring surgery could result in significant medical bills. Health insurance can help cover some of these costs, preventing financial hardship and allowing the insured to focus on recovery. 3. Peace of mind. Knowing you have health insurance can provide peace of mind, allowing you to focus on your health and well-being without worrying about the financial implications of potential health issues. This sense of security can contribute to better mental health and overall well-being. Living with a chronic condition like diabetes can be stressful. Health insurance covering medication and doctor visits can provide peace of mind, allowing insureds to manage their condition effectively and live fulfilling lives. 4. Improved health outcomes. Access to timely and quality healthcare through health insurance can improve health outcomes. Early diagnosis and treatment of medical conditions can prevent complications and enhance quality of life. Regular doctor visits covered by health insurance might lead to earlier detection of a precancerous condition, allowing for prompt intervention and a potentially safe life. 5. Social well-being. Health insurance can enable individuals to participate more fully in social activities and contribute to their communities by providing them the financial means to access healthcare and manage their health conditions. This can lead to stronger social connections and a sense of belonging, contributing to overall well-being. Individuals with chronic conditions can continue working and volunteering thanks to their health insurance coverage, allowing them to maintain social connections and contribute to their community. Consideration for choosing a health insurance plan. Here are some factors to consider when choosing a health insurance plan. 1. The range of plans offered. There are different types of health insurance plans. Some companies provide a range of products to suit insured's varied coverage requirements. Choosing a company that offers a diverse range of plans that fit the insured's needs is vital. 2. The network of hospitals. The network of hospitals is essential for availing cashless claims. The more comprehensive an insurer has a network, the better it will be. 3. Claim settlement ratio. The claim settlement ratio indicates the percentage of claims the company settled in a financial year. A higher ratio indicates that the company is steadfast in settling its claims. 4. Claim-based loading. Some companies tend to increase the renewal premium if the insured made claims in the previous years. This converts to higher premium expenses. As such, avoid companies that follow this practice. 5. Premium rate. Pricing policy is how much premium the company charges vis-à-vis its competitors. The proposer must check the pricing policy by comparing similar plans across different companies. Its premiums, however, depend on the insurer's pricing policy. Compare the plan premium across insurers to find the insurer that charges the least. Chances are that its pricing policy would be fair across all its plans. 6. Ease of claim settlement. Insurers have revolutionized their claim process and made it simpler. Some tools that help ease the claim settlement process include artificial intelligence, AI, which enables claim processing, WhatsApp intimation, digital documentation, quicker approvals, and app-based claim intimation and tracking. Such facilities speed up the claim process and make it hassle-free. Thus, look for insurers that provide such facilities for quicker claim settlements. 7. Reviews. Lastly, pay attention to customer testimonials and reviews. Most insurers showcase their customers' reviews on their websites. It is beneficial to see customers' reviews on insurers' websites. Alternatively, proposers can talk to their friends and relatives about their insurers. If they have made a claim, find out their claim experience to know which company follows the best practices. Health insurance underwriting. Underwriting is the process of evaluating the risk of insuring the individual to determine if it is profitable for the insurance company to take a chance on providing them insurance. After underwriting, that is, assessing the risk, the underwriter determines the premium payable and the terms of the health insurance contract. It is the process of measuring risk to determine the premium accurately. Medical underwriting is what insurance professionals call the process of evaluating an application for health insurance coverage. This is done by looking at the person's medical history to determine the specific risk the applicant would pose to the insurance company. Underwriting is essential for most kinds of insurance, but it becomes trickier for healthcare coverage. Medical underwriting is complex because of many different policies and federal and state regulations. In other kinds of insurance, the coverage may be denied if the applicant poses too high of a risk. Because of federal regulations, private insurers might be unable to deny health insurance coverage to applicants for any reason. Insurance companies want to understand the proposer's medical state during medical underwriting. They will examine critical information, including the medical history, demographics and lifestyle, and estimate the risk associated with providing medical coverage. Suppose the proposer is considered a high-risk prospect. In that case, the insurance company may charge the proposer a high premium, set exclusions and other limitations, or even decline to offer prospect coverage. Professional insurance underwriters who work directly with insurance companies carry out the underwriting process. Underwriters are trained insurance professionals who understand risks and how to prevent them. They review specific information to determine the actual risk and the kind of policy coverage. The work of an underwriter relies on actuarial analysis. It is important to note that insurance agents are different from the underwriters. While the agents or brokers represent the prospect by presenting the situation to the insurance provider and negotiating on behalf of the prospect, the underwriter protects the insurance provider by enforcing rules and assessing the risks. The decision made by the underwriter can be discussed with the insured through the agent or broker. Health insurance underwriting factors. Insurance companies often conduct a thorough assessment of the health profile of the proposer. When applying for health coverage, the proposer will be asked to complete a proposer form that serves as the basis of the health insurance contract. Here are some factors that affect the premium and terms of health insurance. 1. Age. This is one of the critical factors that affect the premium amount. Generally, the insurance companies follow the rule of thumb: the higher the age, the higher the premium. Older people are at a higher risk of suffering from illness than young people. The risk profiles of younger people are typically lower than those of older people, who may be at increased risk owing to age-related health problems. As individuals age, the likelihood of requiring medical services increases, consequently influencing insurance premiums. So, buying health insurance at a young age is beneficial to enjoy paying a low premium. In that case, the prospect will be given comprehensive coverage and better benefits at an affordable premium. 2. Medical history. Medical history is important in the underwriting process. Insurance companies meticulously review past medical conditions, surgeries, hospitalizations, and prescriptions. The proposer's past medical records are crucial in deciding the premium amount. The premium will be higher if the proposer has a history of suffering from illnesses or a pre-existing disease. The premium would be less if the proposer had no sickness and a relatively healthy life. This comprehensive assessment enables insurers to gauge the risks associated with coverage. 3. Family history. Inherited conditions or a family's medical history helps determine health risks and similar conditions. Family medical history must disclose treatment dates, medications, symptom frequency, ongoing consultations and diagnostic tests. Diseases like heart disease and type 2 diabetes could be hereditary and run in families. Some insurers may inquire about the prospect's family's medical history, particularly for hereditary conditions. A strong family history of certain diseases could influence the premium and eligibility for some policies. 4. Lifestyle factors. Specific lifestyle elements, such as smoking, alcohol usage, and participation in hazardous activities, can influence an individual's well-being and raise the chances of insurance claims. For example, it is well known that smoking increases the risk of respiratory issues and lung cancer. Insurance companies may evaluate such factors to determine the premium rates or coverage options. 5. Occupation. Some jobs have higher risk factors and potential health hazards. For example, individuals in physically demanding occupations or those exposed to hazardous environments may face higher health insurance premiums due to the increased likelihood of injuries or illnesses because the nature of the proposer's work and the risk exposure affect the premium charges. The premium will be less if the proposer works in a school. Still, he works in an environment like a construction site or a factory where the risk of injury is higher. In that case, the premium amount will be higher. 6. Policy duration. The tenure of the policy plays an important role. If the prospect chooses a policy with a longer duration, the premium will be less. This may be different for a policy with a shorter duration. 7. Body mass index, BMI. Premium rates are raised if the customer has a high body mass index, BMI. People with high BMI are at risk of serious ailments, including heart disease, type 2 diabetes, breathing problems, high blood pressure and cancer. Generally, people with higher BMI are charged a higher premium than those with a normal BMI. This is because people with high BMI are at a high risk of suffering from various diseases like diabetes and heart-related problems and, therefore, need regular medical care. 8. Weight and height. Weight and height determine the proposer's body mass index, BMI. Those who do not meet the ideal weight and height based on BMI usually increase the standard rates or premium. 9. Smoking habits. Smoking increases health risks, and insurance companies view smokers as high-risk insurance buyers and, therefore, charge high premiums. People who smoke pay high premiums as compared to non-smokers. 10. Geographical location. The location where the prospect stays determines the policy premium cost. The premium rates are high for specific geographic areas due to climate, health issues, and the lack of healthy food options. 11. The selected plan. Premium payments vary depending on the type of health insurance coverage chosen by the prospect. A group health insurance policy has a lower premium than an individual policy. The premium will increase if the prospect has purchased add-on covers. Individual or group insurance has a low premium rate, while family floater has a high premium rate. Again, the policy terms differ from company to company. 12. Co-insurance feature. The premium will be less if the prospect opts for co-insurance when purchasing a health insurance policy. In co-insurance, for any claim, the insured will pay a specific portion of the claim, and the insurance company gives the rest. This step reduces the premium amount significantly. After considering all underwriting factors, the insurance company determines the premium and terms of the health insurance policy. Types of health insurance policies. There are two kinds of health insurance policies: individual or self-plan and family floater policy. Individual or self-health insurance plan. The individual policy only provides coverage and benefits to the primary policyholder. A personal health insurance policy is issued under the name of a single policyholder, meaning that the sum insured coverage and the policy's benefits are dedicated to the insured and cover no one else. Here, the individual purchases the policy to maintain their health, providing financial help in case of their medical emergency. Family Floater Health Insurance Plan. Family Floater Health Insurance is a policy that aims to provide sum insured coverage to an individual and family members. In the Family Floater Plan, only one plan offers coverage for the entire family, including the spouse, dependent children, parent and parents-in-law, or dependent siblings. Rather than taking a single policy for each family member, the Family Health Insurance Plan is a better option, as it acts as an umbrella for the entire family. Here, all the members covered under the same plan share the sum assured coverage. However, having a separate plan for the prospect's senior citizen parent or parents-in-law is advisable as it will be more affordable. Similarly, suppose any member of the family has a substantial medical history. Buying a separate plan is also better than covering them in the Family Floater Plan. Meanwhile, some health insurance companies have limited health insurance policies. Let us explain limited health insurance policies. Limited health insurance policies. Limited health insurance policies are health insurance that cover only certain illnesses or injuries as specified in the contract. These policies are limited because they provide extra coverage for events like cancer and hospitalization. These policies offer additional protection to the assured and the primary health insurance, thereby assisting in paying for costs not covered by the primary policy. There are several types of limited health insurance policies. Travel accident policies are good examples of limited health contracts. These policies cover the insured against death or injury sustained as a passenger on public transport. In contrast, others provide payment in the event of death from a vehicle accident. An inpatient hospital policy, also known as a hospital indemnity policy, is a limited health insurance that pays a specified amount daily for the period the insured is in the hospital, up to a certain number of days. This payment can be used for medical and non-medical costs related to hospitalization, such as food and lodging for family members. The dread disease policy is another example of a limited sickness policy. This contract protects expenses associated with polio, cancer and meningitis. Limited health insurance policies are generally logically inconsistent and violate risk management principles. This is because a proper risk management approach emphasizes the effects of a loss rather than its cause. For example, suppose an individual cannot afford the loss associated with any dread diseases covered under such policies. In that case, the person cannot afford the loss regarding the other catastrophic illnesses that are not covered. Health insurance plans and systems. There are several health insurance plans. The type of health insurance plan that is the best for an individual would depend on several factors based on specific circumstances. Factors which should be considered when comparing health plan options include the individual health, the family health, healthcare providers and the type of insurance accepted, the personal financial situation, whether the person wants to pay more upfront via premiums, and flexibility and specialist referrals options desired. Healthcare plan systems. There are two primary healthcare plan systems, indemnity plan and conventional indemnity plan. Indemnity healthcare plan. A type of medical plan that reimburses the patient and provider as expenses are incurred. The physician billed the patient a fee for the services performed, the patient paid the bill, which the insurance company will subsequently reimburse. Conventional indemnity healthcare plan. An indemnity allows the participant to choose from several providers without affecting reimbursement. These plans reimburse the patient and the provider for expenses incurred. Physicians are reimbursed for authorized tests and treatments, subject to insurance companies' utilization review procedures. Categories of health insurance plans. There are several categories of health insurance plans. All these plans use a network of physicians, hospitals and other healthcare professionals to give patients or participants quality care. Health insurance plans differ in how participants interact with those networks. Here are the four common types of health insurance plans. 1. Health Maintenance Organizations, HMOs, plans. 2. Preferred Provider Organizations, PPOs, plans. 3. Point of Service, POS, plans. and 4. Exclusive Provider Organization, EPO, plans. 1. Health Maintenance Organizations, HMOs, plan. A health maintenance organization, HMO, plan provides a healthcare system that assumes financial risks associated with providing comprehensive medical services, insurance and service risk, and responsibility for healthcare delivery in a particular geographic area to HMO members, usually in return for a fixed prepaid fee. Financial risks may be shared with the providers participating in the HMOs. An HMO health insurance plan requires a participant, an enrollee, to select a primary care physician, PCP, who acts as a gatekeeper because all of the participants' or patients' healthcare services must pass through the primary care physician. The patient needs a referral before seeing any other healthcare professional, except in an emergency. The insurance does not cover visits to healthcare professionals outside the network. HMO is known for its lower premiums and restricted network of doctors and hospitals, hence, participants would sacrifice flexibility for lower upfront costs. Suppose the patient sees a doctor outside the network or without a referral. In that case, they will pay or bear all out-of-pocket expenses, except in an emergency. Coordinating all healthcare through a primary care physician means less paperwork and lower healthcare costs. Not all providers accept HMOs, hence, consumers should ensure that their provider or providers accept the plan. 2. Preferred Provider Organizations, PPOs, plan. A Preferred Provider Organization, PPO, plan is an indemnity plan that covers participants through a network of selected healthcare providers, such as hospitals and physicians. PPO plans allow flexibility. The participant does not need a primary care physician. The participants or enrollees can go to any healthcare professional, within or outside the network, without a referral. The participants or enrollees may go outside the network. Still, they would incur higher out-of-pocket costs and not all services may be covered. Costs associated with using healthcare professionals may be higher deductibles, higher co-insurance rates, or non-discounted provider charges. However, staying inside the network means smaller co-pays and full coverage. If a participant goes outside the network, he will have higher out-of-pocket, and some services may be excluded. 3. Point of Service, POS, plan. POS plans are a hybrid of an HMO and a PPO plan. POS plans allow the healthcare consumer to choose whether to use HMO or PPO services each time they see a provider. Depending on the consumer's choice, like an HMO, the consumer will need a referral from a primary care physician, PCP, to see a specialist. Like a PPO plan, consumers will pay less if they use doctors, hospitals, and other healthcare providers in the plan's network. The consumer will have access to out-of-network providers at an increased cost. 4. Exclusive Provider Organization, EPO, plan. An exclusive provider organization, EPO, plan is a more restrictive type of preferred provider organization plan under which employees must choose providers from the specified network of physicians and hospitals to receive coverage. It does not provide care coverage received from a non-network provider except in the case of an emergency. EPOs offer more flexibility than an HMO and are less expensive than a PPO. Like a PPO, a consumer does not need a referral to get care from a specialist. But like an HMO, the consumer would be responsible for paying out of pocket if they seek care from a doctor outside the plan's network. An EPO is an excellent option to see specialists within the network without a PCP referral. Utilization of healthcare services. The healthcare system has three major players. 1. Healthcare providers, including doctors, nurses, and hospitals. 2. Employees and individuals who seek and consume healthcare. And 3. Employers and insurers who provide insurance to pay individuals unexpected healthcare costs. Group medical coverage generally leads to moral hazard, which increases the cost of medical care. There are two aspects of moral hazard problems associated with group medical coverage. First, The group nature of coverage implies that premium contributions of employees and foregone wages used for the employer's contribution generally are not closely related to the individual employee's expected claim costs. Second, moral hazard associated with group medical coverage can lead to excessive healthcare utilization once a person develops an ailment. This implies that health services can be overutilized, that is, excessive utilization. Excessive utilization of health services occurs when a patient receives care for which the cost of providing the care exceeds the expected benefit to the patient, where the expected benefit to the patient depends on the value that a typical person would place on the expected improvement in health status, including any lessening of risk that the condition will worsen. Consequently, moral hazards associated with group medical coverage may lead to overutilization of healthcare if a person, participating individual or employee, develops an ailment. This is obvious as patients typically bear only a small part of the cost of care under medical insurance. Means of reducing moral hazards in contracts, including health insurance contracts, include 1. The insured bears part of the loss, policy excess or deductible. 2. Previous claims experience rating. 3. Limiting the amount of insurance coverage or limit of liability. And 4. Claim investigation and monitoring by insurers. Medical underwriting in health insurance. Medical underwriting refers to using medical information to evaluate an application for private health insurance to decide whether to accept it and, if so, at what premium rate and with what benefit limits. Medical underwriting is the process that health insurance companies use to assess the risk of insuring the prospect. They do this by looking at the prospect's medical history, including pre-existing medical conditions, family medical history, and lifestyle habits, such as smoking or alcohol use. Based on this information, the insurance company will decide whether or not to offer the prospect coverage and, if so, at what price. The type of underwriting also determines which health conditions are and are not covered. Different underwriting options are available depending on whether the proposer is new to health insurance or switching providers. Medical underwriting is a complex process that can significantly impact the cost of health insurance. Medical underwriting requires the professional to obtain the applicant's medical information via a health questionnaire. From here, the questionnaire is assessed to determine the risk that taking the individual on as a policyholder would pose for the insurance company. To do this, the applicant may have to provide medical records to the insurer. The goal of the underwriting process is to avoid the highest risk posed by a particular medical condition on the insurance company's part. When a company becomes too overwhelmed with high-cost risk, the insurer may need to raise premium rates above usual costs for those with coverage to compensate for the possibility of higher claim payouts. Remember that some circumstances prohibit an in-depth underwriting process. Here is how the medical underwriting process works. 1. Personal health questionnaire provides the insurance company with essential health information on the applicant. 2. Attending physician statement, APS, this is only necessary if there are any significant concerns from the initial questionnaire. 3. Prescription evaluations, the underwriter should analyze the applicant's prescriptions from the past few years. These are the basic requirements that the underwriting process needs to be successful. Sometimes, the process needs more medical history research to determine an accurate risk assessment. Because of this, the amount of time it takes for the underwriting process to complete can be highly variable. How medical underwriting works. When a proposer applies for health insurance, the person must complete a proposal form containing questions relevant or material to the contract. The proposal form includes questions about the proposer's medical history, including pre-existing conditions. The proposer may also be required to provide medical records from the prospect's doctor. The insurance company will then use this information to assess the risk of making future claims. Suppose the prospect has a high risk of making claims. In that case, the insurance company may decline the coverage, offer coverage at a higher premium, and exclude certain pre-existing conditions from coverage. Let us consider examples of medical underwriting. Let's say the proposer has a history of cancer. The insurance company may deny the prospect's coverage for cancer treatment or offer coverage at a higher premium. If the proposer is a smoker, the insurance company may charge the prospect a higher premium for health insurance. If the proposer is pregnant, the insurance company may not cover maternity care unless the insured has been enrolled in their plan for a certain period. Types of medical underwriting. There are different types of medical underwriting, including moratorium, full medical, continued personal medical exclusions, continued and switch, and medical history disregarded. 1. Moratorium underwriting. Moratorium medical underwriting does not require the insured to declare their complete medical history up front. Instead, it excludes coverage for any conditions the insured has had symptoms, advice, or treatment during the past 5 years. However, after a continuous 2-year trouble-free period after starting the policy, the insured will be entitled to cover such conditions. Moratorium underwriting focuses on how pre-existing medical conditions are handled during the initial years of coverage. Here are the key features of moratorium underwriting. 1. Moratorium underwriting allows the insured to get health insurance without disclosing pre-existing medical conditions from a specific time frame, usually 5 years, before the policy start date. 2. However, there is a waiting period of typically 2 years, during which coverage for these pre-existing conditions is excluded. 3. After the waiting period, the insurance may cover fully or partially if the insured has not required treatment for pre-existing conditions. Types of moratorium underwriting. There are 2 types of moratorium underwriting, fixed and rolling. Fixed moratorium, this is the waiting period duration that remains fixed regardless of whether you seek treatment for pre-existing conditions during that period. Rolling moratorium, this is the waiting period that restarts if you receive treatment or medication for a pre-existing condition during the initial waiting period. Who might benefit from moratorium underwriting? The following health insurance prospects may benefit from moratorium underwriting. 1. Individuals with past medical conditions who want quick access to coverage but can wait for full pre-existing condition coverage. 2. People who want to keep their medical history private. However, prospects should carefully review the policy details to understand the moratorium terms, including the waiting period duration, exclusions, and limitations on pre-existing condition coverage. It is good to consider the current health needs and future risks when deciding if moratorium underwriting suits you. It is also essential to consult a financial advisor or insurance broker to understand the economic implications and choose the best plan for your needs. Pros and cons of moratorium underwriting. Advantages of moratorium underwriting. 1. Easier to obtain coverage. The prospect doesn't need to disclose past medical history initially, making getting insured easier for people with pre-existing conditions. 2. Lower initial premiums. Premiums may be lower since pre-existing conditions are not considered upfront. 3. Chance for full coverage. Pre-existing conditions might be covered after the waiting period, depending on the policy and your health status. Disadvantages of moratorium underwriting. 1. Limited coverage during the waiting period. Any medical needs related to pre-existing conditions won't be covered during the moratorium period. 2. Uncertainty of future coverage. Even after the waiting period, coverage for pre-existing conditions may be limited or excluded depending on policy terms and your health history. 3. Potential for higher future premiums. Your premiums could increase significantly if you claim for a pre-existing condition after the waiting period. 2. Full medical underwriting. Full medical underwriting is a comprehensive approach to assessing your risk profile for health insurance. Full medical underwriting usually requires a prospect to disclose medical history to the insurer, who will then provide a list of specific exclusions based on pre-existing medical conditions. However, the entire medical underwriting route is unique to different insurers, so it may only sometimes lead to exclusions. Unlike moratorium underwriting, which focuses on recent medical history, full medical underwriting delves deeper, reviewing your complete medical history to determine your eligibility for coverage and plan pricing. Here are the key features of full medical underwriting. 1. Disclosure. The prospect must disclose a complete medical history, including pre-existing conditions, past surgeries, medications, family history, and lifestyle habits like smoking or alcohol consumption. 2. Detailed analysis. The insurance company analyzes the prospect's medical records, doctor's reports, and other relevant information provided. 3. Risk assessment. Based on the prospect's health history, they assess your risk of needing future medical care and estimate the potential costs the insurance company might incur. 4. Impact on coverage. The results of the underwriting process can affect your coverage eligibility, the plans available to you, and the associated premiums. Who might benefit from full medical underwriting? The following health insurance prospects may benefit from full medical underwriting. 1. Individuals with a clean or primarily clean medical history seek competitive premiums. 2. People who want clear and upfront information about their coverage. 3. Individuals with pre-existing conditions who are confident their condition is stable and well managed potentially qualify for coverage. It is, however, necessary for prospects to be truthful and complete in their disclosures. Withholding information could affect your coverage or lead to claim denials. This is essential to understand the policy details, including exclusions, limitations, and waiting periods. Compare plans and underwriting approaches before making a decision. Individuals should consider consulting a financial advisor or insurance broker to navigate the process and choose the best option. Pros and cons of full medical underwriting. Full medical underwriting offers transparency and clarity but requires disclosing your medical history. Carefully weigh the pros and cons and understand the potential implications before choosing this type of underwriting. Advantages of full medical underwriting. 1. Transparency. You know upfront whether you're covered and what limitations or exclusions apply. 2. Potential for competitive premiums. If you have a healthy history, you could qualify for lower premiums than moratorium underwriting. 3. Coverage for pre-existing conditions. Depending on the specific plan and your medical history, some pre-existing conditions might be covered after a waiting period or with limitations. Disadvantages of full medical underwriting. 1. Potential for exclusion or denial. If your medical history indicates high risk, coverage could be denied or come with significant exclusions and high premiums. 2. Disclosure required. Sharing your complete medical history might feel daunting for some. 3. Limited availability. Not all insurance plans offer full medical underwriting, and regulations might vary based on location. 3. Continued personal medical exclusions. Continued personal medical exclusions offers a convenient way to switch insurance providers while maintaining coverage for previously excluded conditions. It allows an insured to switch providers while maintaining the same personal exclusions applied by your previous plan due to pre-existing medical conditions. However, it's essential to understand the limitations and carefully evaluate your needs before choosing this option. Suppose an insured is looking to change the current health insurer. In that case, the insured might be allowed to switch on a continued personal medical exclusion basis. This often means the new insurer might retain the current underwriting and continue covering the same conditions. Each insurer has its eligibility criteria. New exclusions may be added to the policy if the insured still needs to meet the switch requirements. How continued personal medical exclusions works. The person must have an existing health insurance plan with some pre-existing conditions excluded from coverage. The person must decide to switch to a new provider. Instead of undergoing full medical underwriting again, he can opt for continued personal medical exclusions. This way, the new insurer accepts the existing exclusions without reassessing the overall health history. The insured gets coverage for everything not previously excluded, just like in the old plan. Who might benefit from continued personal medical exclusions, CPME? 1. Individuals with pre-existing conditions who are happy with their existing coverage and want to switch providers for better benefits or pricing. 2. People concerned about being denied coverage or facing higher premiums due to their medical history. However, the insureds must carefully review the terms of their previous and new insurance plans to understand the specific exclusions covered under CPME. Consider if you develop new medical conditions in the future, as they won't be covered under CPME. Compare plans and underwriting options before making a decision. Consult with a financial advisor or insurance broker to understand if CPME is the right choice based on your circumstances. 4. Continued moratorium or switch moratorium. Continued moratorium and switch moratorium are options related to pre-existing conditions when switching health insurance providers. Continued moratorium underwriting is available to those switching health insurance originally underwritten on moratorium terms. It allows the insurer to use the existing underwriting and the previous health insurance terms and conditions. However, it is essential to determine whether the provider will apply their moratorium terms and honor the existing insurer's wishes before switching. For example, suppose you have met the trouble-free clause with your previous insurer. In that case, you should keep these moratorium terms to be eligible for cover for this pre-existing condition. While continued moratorium and switch moratorium share similarities, there are key differences to understand before deciding. Similarities. Both allow you to switch insurance providers without disclosing your complete medical history, including pre-existing conditions. This can be beneficial if you have pre-existing conditions that might lead to denial of coverage or higher premiums under full medical underwriting. Both typically involve a waiting period after switching before coverage for pre-existing conditions kicks in. Differences. Continued moratorium. This applies to individuals already enrolled in a moratorium underwriting plan. The waiting period from your existing plan carries over to the new plan. Any pre-existing conditions excluded in your old plan remain excluded in the new plan. It is a simpler and faster process, utilizing the existing moratorium status. Switch moratorium. Available to anyone switching providers, regardless of their previous plan, not limited to those already under moratorium. A new waiting period starts upon switching, typically 12 to 24 months. Pre-existing conditions might be covered after the waiting period, depending on the new plan's terms and your health status. It is a more complex process requiring assessing your health history to determine coverage for pre-existing conditions. Who might benefit from each option? Who might benefit from a continued moratorium? Individuals happy with their existing moratorium plan and want to switch providers. Those with stable pre-existing conditions are already excluded from their current plan. Who might benefit from the switch moratorium? Individuals with pre-existing conditions seeking wider coverage options or better premiums than their current plan. People are unsure about their plan's future and want coverage for pre-existing conditions. By understanding the nuances of continued and switch moratoriums, individuals can make an informed decision when switching health insurance providers, ensuring they receive the best coverage for their needs. Hence, the need to carefully review the terms and conditions of existing and new plans, including waiting periods and exclusions. Both options still come with limitations and exclusions for pre-existing conditions. Consider the current and future health needs when choosing between continued or switched moratoriums. Consult a financial advisor or insurance broker to clarify your options and select the best fit. 5. Medical history disregarded. Medical history disregarded, MHD, is a specific type of health insurance underwriting approach that disregards your past medical history when determining your eligibility for coverage and premium costs. Past medical history and pre-existing conditions might not necessitate exclusions when a group policy begins. Each person on the document will be covered for pre-existing and new conditions until the end date. Medical history disregarded underwriting is typically only available on company private health insurance with a minimum group size of 15 employees. It allows a prospect to purchase health insurance without disclosing pre-existing conditions. Critical features of medical history disregarded, MHD, include 1. No medical questions. Unlike traditional underwriting, the prospect doesn't need to answer questions about your medical history or provide medical records. 2. Guaranteed acceptance. If the person meets other eligibility criteria, for example, age, location, he is guaranteed coverage regardless of pre-existing conditions. 3. Fixed premiums. Everyone enrolled in the MHD plan pays the same premium, regardless of their health status. 4. Coverage for most conditions. Most medical conditions are covered, including pre-existing conditions, after a defined waiting period, can vary by plan. Benefits of medical history disregarded, MHD, include 1. Faster and easier enrollment. No need for lengthy medical questionnaires or underwriting processes. 2. Access to coverage for everyone, ideal for individuals with pre-existing conditions who might struggle to get traditional insurance. 3. Peace of mind. Knowing you're covered regardless of your health history can bring peace of mind. Limitations of medical history disregarded, MHD, include 1. Higher premiums. Due to covering everyone regardless of risk, MHD plans typically have higher premiums than traditional plans with risk-based pricing. 2. Waiting period. Coverage for pre-existing conditions might be delayed by a waiting period, typically ranging from 6 months to 2 years. 3. Limited plan options. MHD plans might have fewer coverage options or network choices than traditional plans. Who might benefit from medical history disregarded, MHD? 1. Individuals with pre-existing conditions who face difficulty getting traditional insurance. 2. People starting a new business or self-employed individuals who need immediate coverage without underwriting hassles. 3. Companies looking for group health insurance coverage for their employees without individual health assessments. Medical history disregarded offers a simplified and straightforward way to access health insurance, but it comes with higher premiums and potential limitations. Evaluating a person's needs and comparing options will help determine if MHD is the right choice for your health insurance journey. Furthermore, the following should be noted. Carefully review the specific terms of the MHD plan, including premium costs, waiting periods, and covered services. MHD might be a more cost-effective option for some, especially if you have a clean bill of health. Compare MHD plans with traditional options based on your needs and budget. Consult with a financial advisor or insurance broker to understand if MHD fits you. Having explained the types of medical underwriting, it is necessary to address 2 questions. 1. What is the best medical underwriting for my health insurance policy? And 2. How does medical underwriting vary between health insurance providers? What is the best medical underwriting for my health insurance policy? The best medical underwriting choice for health insurance depends on whether the insured is switching insurers and pre-existing medical conditions. Moreover, moratorium underwriting is often used when someone starts private medical insurance. However, even if the insured has had private medical insurance for many years, moratorium underwriting could be the most cost-effective option, depending on the insured's medical history. It is, however, essential to seek professional advice to choose the proper medical underwriting. The next question is: how does medical underwriting vary between health insurance providers? The language used by a potential provider can make a massive difference in the medical underwriting process, which is why it is so important to seek advice. This is best illustrated with an example. Supposing Hannah wishes to purchase private health insurance for the first time. She had spinal surgery 6 years ago and has had no treatment since being signed off 5.5 years ago. She has, however, seen a specialist about hip pain in the last 12 months. Her specialist said it was nothing to worry about and put the pain down to wear and tear. 2 insurers offer to cover an event from day one, but won't cover anything related to her hip pain. With the first provider, Sarah would meet the trouble-free clause and be able to claim for hip issues after 2 years without treatment, advice, or medication. However, the second provider's trouble-free clause includes treatment, advice, medication, signs and symptom-free. In this case, the first option is more suitable for Hannah. The specialist said her hip pain was down to wear and tear, a phrase often used to describe osteoarthritis, which is a condition that will likely present signs and symptoms. It would, therefore, be challenging for Hannah to claim for this condition on the second policy successfully. Though she probably would not know this herself, an expert advisor could explain the difference and help her make the right choice. Limitations of medical underwriting. Medical underwriting has been criticized for being unfair to people with pre-existing conditions. In the past, it was common for people with pre-existing conditions to be denied health insurance altogether or to be charged prohibitively high premiums. However, the Affordable Care Act, ACA, has made it illegal for insurance companies to deny coverage or charge higher premiums based on pre-existing conditions. The ACA also limits how much insurance companies can charge people based on their health status. Alternatives to medical underwriting. There are a few alternative ways to price health insurance that do not rely on medical underwriting. One option is to use community rating, meaning everyone in a given community pays the same premium for the same plan, regardless of their health status. Another option is to use experience rating, which means that people with higher healthcare costs pay higher premiums. Health insurance underwriting decisions. There are different types of underwriting decisions, including 1. Standard coverage rates. This decision means that the original quote for coverage and premium during the application for health insurance is accepted. The standard coverage or rate decision is usually what most applications for insurance coverage receive, especially when working with companies with a low declination rate. 2. Exclusion of coverage. Aptly named, the insurance company will not pay for claims for a particular condition resulting from a high-risk activity or chronic disease. These exclusions in the standard coverage usually apply to a critical illness and disability policy or coverage. 3. Premium loadings. The premium cost increases if they find additional complex risks for claims after a risk status evaluation or underwriting process. Some insurance companies call it the extra mortality loading. Most of them will calculate the additional risk cost as the multiple of the basic premium. 4. Postpone. After evaluating the risk factors, the insurer may postpone a health insurance application if the current risk is too high but expected to improve. This decision is also joint for applications from people awaiting medical examination results and diagnoses. 5. Denial of coverage. Unfortunately, some individuals cannot be offered medical plans and similar coverages because of their high-risk status. The declinable health conditions will vary from company to company. However, some companies with a high decline rate usually do not offer policies to people with heart disease and diabetes. On the other hand, others only exclude these diseases or are part of their life insurance's standard coverage but with a higher premium. I have explained the meaning of health insurance, its types, underwriting, and benefits. It is necessary to discuss the differences between health, life, and medical insurance. First, I will examine the differences between health insurance and life insurance. After that, I will discuss the differences between health insurance and medical insurance. Differences between life insurance and health insurance. What is life insurance? Life insurance is a financial safety net that supports insured loved ones in case of unexpected death. It is like a promise made by the insured to ensure their family's well-being after death. While death can be unpleasant, purchasing life insurance shows foresight and responsibility, offering the insured family and estate peace of mind and financial security. Benefits of life insurance. Here are some benefits of life insurance. 1. Financial protection. The primary benefit of life insurance is the death benefit paid to the designated beneficiaries after the insured's death. This lump sum payment can help them cover various expenses, including mortgage payments. Ensure the insured family can keep their home without financial hardship. Living expenses, to meet the insured's family's daily needs like food, utilities, and education. Debt repayment, to eliminate outstanding debts like credit cards or loans. Long-term goals, to enable the insured's dependents to pursue higher education, start a business, and achieve other aspirations. 2. Peace of mind, knowing your loved ones are financially protected can offer immense peace of mind and reduce stress during a difficult time. 3. Estate planning tool, life insurance can be valuable for estate planning, minimizing tax burdens and simplifying the inheritance process for your beneficiaries. 4. Other benefits. Some life insurance policies offer additional benefits like cash value accumulation, which can be accessed during your lifetime for specific needs like retirement income or emergencies. Types of life insurance coverage. There are 4 basic life assurance policies: term assurance, whole life assurance, endowment assurance, and universal life insurance. 1. Term life insurance. Term assurance is a basic form of life assurance that covers pure protection with no investment element. This is because a payment is made if the life assured dies during the policy term, and no payment is made if the life assured survives the term. This covers a specific period, typically 10, 20, or 30 years. If the insured dies within the term, the death benefit is paid to his beneficiaries. The policy expires if the insured outlived the term and no payout is made. Term life insurance is usually more affordable than other types. 2. Whole life policy. A whole life policy pays on the death of the life assured whenever that occurs. A whole life policy differs from a term life insurance policy, which protects for a specified period. Provided required premiums are paid, a whole life policy guarantees payment of a lump sum to the policyholder's family or beneficiaries. The policyholder pays a level premium, which usually does not increase with age. Whole life policy premiums are fixed based on the age of the issue. The policyholder usually pays premiums until death, except for limited pay policies, which may be paid up in 10 years, 20 years, or at age 65. A whole life policy provides cover for the life assured entire lifetime, whole life, payable after the policyholder's death. 3. Endowment assurance. With endowment insurance, as with term life insurance, the focus is on the length of the policy's terms, usually 10 to 20 years. Suppose the insured dies before the endowment's maturity. In that case, the policy's face value, the death benefit, will be paid in a lump sum to the appointed beneficiaries. The policy death benefit will be paid to the policyholder if the insured is alive at the policy maturity. An endowment policy provides for payment of the sum assured on a specified date, maturity date, or the earlier death of the life assured. Level premiums are payable for the duration of the contract. There will be a payout at some stage. Premiums for endowments are generally more expensive than whole life assurances because claim payments are made earlier. 4. Universal life insurance. Universal life insurance is a flexible permanent life insurance policy with an adjustable premium and death benefit during the period of insurance. Universal life insurance shares the same essential components as whole life insurance, i.e., a cash value, but may offer more options. The policy's accumulated cash value is adjustable based on the financial market and trends but with a guaranteed minimum interest rate. Universal life may have lower premiums for the same death benefit amount than the whole life. However, the underlying cost of the actual life insurance coverage will rise over time, unlike with whole life policies. It accumulates cash value and comes with investment options. There are two basic types of universal life insurance: variable and indexed universal life insurance. Practical examples of life insurance benefits. Example 1, John, a young father, purchases a term life insurance policy to ensure his family can maintain the financial stability if he dies prematurely. This allows his wife to stay at home with their children and focus on grieving without worrying about finances. Example 2, a single mother, Sarah, buys a permanent life insurance policy to secure her daughter's college education. She utilizes the policy's cash value to make regular contributions to a college savings plan, guaranteeing her daughter's future education even if she cannot witness it. Example 3, Mark, a successful entrepreneur, takes out a whole life insurance policy to cover estate taxes and provide his family with additional financial security when he passes away. This ensures a smooth transfer of his assets and minimizes the financial burden on his loved ones during a difficult time. Choosing the right life insurance. The type and amount of life insurance you need depend on your circumstances, including your age, income, family situation, and financial goals. Consider consulting with a financial advisor to determine the best coverage for your needs. Life insurance is an investment in the future of your loved ones. It is a selfless act that demonstrates your love and provides them with a safety net when they need it most. Critical differences between life insurance and health insurance. Despite the shared term insurance, life insurance and health insurance serve distinct purposes and offer different types of protection. Here are the essential differences between life insurance and health insurance. 1. Life insurance focuses on financially protecting the insured loved ones in the event of his death. The death benefit is paid to the appointed beneficiaries upon the insured's death. The death benefit paid provides them with resources to manage living expenses, debts, and future goals. Health insurance covers the insured's medical expenses during his lifetime. It helps manage the financial burden of illness, injury, or disability by providing partial or complete coverage for various healthcare services. 2. Life insurance offers a one-time lump sum payment upon the insured's death. In contrast, health insurance provides ongoing coverage for eligible medical expenses as long as the insured keeps paying the premiums. 3. Life insurance premiums are typically based on the insured's age, health, and the amount of coverage chosen. Generally, younger and healthier individuals pay lower premiums than older individuals or those with pre-existing conditions. Health insurance premiums are often based on age, location, health status, chosen plan, and deductible. 4. Life insurance provides financial support to insured beneficiaries after their death, helping them maintain their well-being and plans. Health insurance mitigates the financial burden of healthcare costs, preventing medical bills from draining the insured's savings and economic stability. 5. Some life insurance policies offer cash value accumulation, providing an investment component alongside death benefit protection. Health insurance often operates within a network of contracted healthcare providers, while life insurance does not have network restrictions. Furthermore, coverage for pre-existing conditions might be limited or excluded in both types of insurance depending on the policy and regulations. 6. Life insurance is like a parachute, offering a safety net for the insured loved ones in case of an unexpected death. Health insurance is like a shield, protecting the insured from financial loss and unforeseen medical emergencies. Choosing between them depends on individuals' needs and priorities. Life insurance might be a priority for economic security for young individuals or those with dependents. Health insurance becomes crucial when facing frequent medical needs or anticipating significant healthcare expenses. Ultimately, having both, life and health insurance, provides comprehensive protection for the insured and the future of the loved ones. Having differentiated between life insurance and health insurance, we now proceed to discuss the differences between health insurance and medical insurance. Differences between health insurance and medical insurance. What is medical insurance? Medical insurance is a financial safety net that helps a person manage the costs associated with his healthcare. It protects against ever-growing medical expenses, providing peace of mind and security in case of illness, injury, or disability. Benefits of medical insurance. Here are some benefits of medical insurance. 1. Financial security. Medical bills can be astronomical, especially for major illnesses or surgeries. Insurance significantly reduces the financial burden, allowing the insured to focus on recovery without worrying about the costs. 2. Access to quality healthcare. Insurance grants access to a broader network of healthcare providers and specialist care, ensuring the insured receives the best treatment. 3. Preventive care coverage. Many plans cover preventive care like checkups, screenings, and vaccinations, helping the insured stay healthy and potentially preventing future medical issues. 4. Peace of mind. Knowing you are covered in case of unexpected medical needs provides immense peace of mind and reduces stress, contributing to overall well-being. Covers provided by medical insurance. Here are the fundamental covers provided by medical insurance. 1. Hospitalization. This covers expenses incurred during a hospital stay, including room charges, doctor fees, nursing care, and diagnostic tests. 2. Surgery. Insurance covers the surgeon's fees, operating room charges, anesthesia, and other related surgery-related expenses. 3. Ambulatory care. This covers costs for outpatient services like doctor's visits, lab tests, and x-rays. 4. Maternity care. Prenatal care, childbirth, and postnatal care are often covered under maternity benefits. 5. Prescription drugs. Many plans cover a portion of the cost of prescription medications, making them more affordable. The specific covers and limitations vary depending on the chosen insurance plan. However, it is essential to review the plan details to understand the policy coverages carefully. Practical examples and benefits of medical insurance. Here are some valuable examples of how medical insurance can be beneficial. Example 1, John, a young man with a chronic condition, requires regular medication and doctor visits. His health insurance covers many of these costs, allowing him to manage his condition effectively and live an everyday life. Example 2, a working professional, James, gets into a car accident and needs surgery. Her health insurance covers the surgery costs, hospital stay, and rehabilitation, preventing a financial catastrophe and allowing her to focus on recovery. Example 3, Mary, a pregnant woman, utilizes her health insurance for prenatal care, childbirth, and postnatal checkups. This ensures that she and her baby receive medical attention without financial strain. Medical insurance protects the insured's health and well-being. Hence, it would help if you chose a health insurance plan that fits your needs and budget to reap its numerous benefits. Critical differences between health insurance and medical insurance. While health insurance and medical insurance are often used interchangeably, they have critical differences. Here are the essential differences between health insurance and medical insurance. 1. Health insurance offers a broader range of coverage, encompassing medical expenses and other wellness-related services. This might include preventive care like checkups, vaccinations, routine dental care, coverage for alternative therapies, vision care, mental health services, and gym memberships. Medical insurance primarily covers expenses related to acute illness, injury, or disability. This typically includes hospitalization, surgery, outpatient services like doctor visits, diagnostic tests, and certain prescription medications. 2. Health insurance generally employs cost-sharing mechanisms like deductibles, co-pays, and co-insurance. These require the policyholder to share a portion of the covered medical expenses. Medical insurance may also involve cost sharing, but often to a lesser extent than health insurance. This could involve higher deductibles and co-pays for specific services. 3. Some health insurance plans offer flexibility in choosing any healthcare provider. In contrast, others have a network of preferred providers with lower costs and benefits like cashless claims settlement. Medical insurance operates within a network of contracted hospitals and doctors, restricting the choice of providers to access full coverage benefits. 4. Health insurance premiums tend to be higher due to the broader range of services covered. Medical insurance premiums might be lower due to the narrower scope of coverage. 5. Health insurance promotes overall well-being by encouraging preventive care and offering a more holistic approach to health. Medical insurance primarily reacts to unexpected medical needs and provides financial protection against high medical bills. 6. Depending on the country and regulations, coverage for pre-existing conditions might be limited or excluded in either type of insurance. Both types of insurance may have specific exclusions, so carefully review the policy details before purchasing. 7. Think of health insurance as a comprehensive umbrella protecting the insured's health and well-being. Consider medical insurance as a shield against the financial impact of unexpected medical emergencies. Choosing between them depends on the individual's needs and budget. If you prioritize preventive care and a holistic approach to health, health insurance might be a better fit. Medical insurance could be sufficient if you are primarily concerned about financial protection from medical emergencies. Ultimately, the best choice is the one that provides the coverage you need at a price you can afford. After explaining the differences between life, health and medical insurance, let us discuss factors to look for in health insurance terms and conditions. Factors to look for in health insurance terms and conditions. Look for these clauses in the terms and conditions before buying a health insurance policy. 1. Sum insured. When choosing a health insurance policy, you should select one with a sum insured amount that is enough to cover potential needs. For example, paying a higher premium for coverage of specific illnesses may be worth paying if you have pre-existing conditions. 2. Claim process. The objective of a health plan is to get paid for any legitimate claim during times of need. Therefore, you should choose an insurer that follows simple and fast claim processing and has good customer support. 3. Network hospitals. They allow you to get treatment without paying cash as they are directly associated with the insurer. The more hospitals are included in the insurer's network, the easier it is to get the cashless facility from anywhere, especially during an emergency. 4. Waiting period. You have to wait before raising a claim under your health insurance policy. Make sure to choose the policy with the least waiting period to avoid being in a medical emergency with no health coverage. We will discuss the waiting period later in this video. 5. Co-payment clause. This clause in medical insurance policy refers to a certain percentage of the claim amount one has to pay out of pocket when making a claim. A higher copayment decreases out-of-pocket expenses but increases the insured's financial burden during medical emergencies. We will discuss the copayment clause later in this video. 6. Lifelong renewability. Some health insurance policies offer the option to renew it every year. Choosing a health plan with a lifelong renewal facility is beneficial as it lets you avoid higher premiums due to age. 7. Type of health insurance plan chosen. Health insurance products come in different types for different needs. Check the policy terms to know what kind of health plan you buy. There are 4 common types of health insurance plans: health maintenance organizations, HMOs, preferred provider organizations, PPOs, point of service, POS, and exclusive provider organization, EPO, plans. 8. Coverage of health insurance plans. The coverage provided by a health insurance plan must be understood to maximize the benefits provided. A health insurance plan can offer the following coverage depending on the insurer and the specific policy terms. 1. Hospitalization expenses. It includes all medical expenses incurred after the patient gets admitted to a hospital for over 24 hours. For example, it covers some expenses, including room rent, medicine costs, diagnostic test charges, and doctor's fees. 2. Pre- and post-hospitalization expenses. This includes medical charges for specific days before admission and follow-up treatment costs after discharge. 3. Daycare expenses. Some medical treatments do not require the patient to be admitted for 24 hours. Daycare expenses include these advanced treatments. 4. Doctor's fees. Health insurance plans cover health fees, including consultation fees for doctors, specialists and nurses. 5. Room rent. This includes rent for regular wards or ICUs, intensive care units. Some do not have a cap on room rent, allowing the insured to rent the best rooms. 6. Maternity or newborn cover. This includes all medical expenses incurred during pregnancy and delivery and any treatment costs for the newborn baby for up to 90 days. Now, let us discuss the co-payment clause. Co-payment clause. Health insurance plans might have co-payment clauses for different reasons. A co-payment clause in health insurance is a policy provision that requires the insured to pay a specified percentage of the insured medical expenses for each claim. Hence, the co-payment clause is a cost-sharing agreement between the policyholder and the insurer. How co-payment clause works. Co-payments mean the insured must pay a specified part of the claim from his pocket. For example, a co-payment of 10% means that 10% of every claim would be borne by the insured. The insured incurs a medical expense covered by your insurance plan. This could be anything from a doctor's visit to a hospital stay. The insured pays the co-payment amount at the time of service. This amount is usually stated in the policy documents or insurance card. The insurance company pays the remaining covered amount. This could be a percentage of the remaining bill or the entire bill, depending on the terms of the health insurance plan. The purpose of co-payment clauses is to 1. Encourage policyholders to use preventive care services. By requiring them to pay a small amount out of pocket, co-payments can help deter people from unnecessary doctor's visits or tests. 2. Reduce the overall cost of health insurance for everyone. By sharing the cost of care, co-payments can help to keep premiums down. 3. Promote responsible use of healthcare services. Knowing they must pay a portion of the bill, policyholders may be more likely to choose the most cost-effective treatment options. Here are some things to consider when choosing a health insurance plan with a co-payment clause. 1. The amount of the co-payment. Higher co-payments mean the insured pays more out of pocket each time he uses a covered service. 2. The services that are subject to co-payments. Some plans may have co-payments for all covered services. In contrast, others may only have co-payments for certain services, such as doctor's visits or prescriptions. 3. Your budget. Can you afford to pay the co-payments required by the plan you are considering? Co-payment clauses can be an excellent way to save money on health insurance premiums. However, choosing a plan with co-payments you can afford and meet your needs is vital. Having explained the co-payment clause, let us discuss the waiting period. Waiting period. The waiting period is when the health insurance policy does not allow specific coverage. Once the waiting period is over, coverage is allowed. Health insurance plans impose waiting periods in various instances. These include the following. 1. First 30 or 60-day waiting period for the coverage of illnesses. This is also called the cooling-off period, during which illnesses are not covered. Accidental injuries, however, are covered from day one of the health insurance contract. 2. Waiting period for specific illnesses or treatments, including hernia, fissures, hydrocele, tonsillectomy, cataract, and joint replacement. This waiting period is generally 24 months. In some plans, however, the tenure might vary. 3. Pre-existing waiting period ranges from 12 months to 48 months. This waiting period is for the prospect's illnesses and medical conditions when purchasing a new policy. Complications arising out of existing conditions are not covered during this period. 4. The maternity waiting period might range from 9 to 48 months. 5. Waiting period for the coverage of expenses and bariatric treatments. Waiting periods are inevitable. However, it is good to find a plan with a low period. This is essential if the prospect is looking for maternity coverage or have pre-existing conditions and want coverage as soon as possible. Standard exclusions of health insurance policies. Here are standard exclusions of health insurance policies. Except for a few health plans, most do not cover claims in the first 30 days of buying the policy. These cover pre-existing diseases only after a specific waiting period. Cosmetic procedures, including plastic surgery and hormone replacement therapy. Dental treatment and eye surgery. Self-inflicted injuries or suicide attempts. Critical illness cover comes after a waiting period. Injuries from adventure sports. Injuries from war, terrorism or nuclear activity. Sexually transmitted diseases like AIDS. Non-medical expenses, including service charges and toiletries. Non-prescription drugs. Health insurance policy exclusions vary depending on the insurer and health insurance terms and conditions. Reading the policy to understand its terms and conditions is also essential. Lastly, discuss what to avoid when purchasing a health insurance policy. Things to avoid when buying a health insurance policy. The following things should be avoided when buying a health insurance policy. 1. Avoid rushing to buy a policy. Wait to buy a health insurance plan. Proper research and selecting the best health insurance for you and your family is advisable. You can compare premium quotes online before choosing a health insurance policy. 2. Choosing insufficient coverage. The premium cost is a significant consideration while buying a health plan. Do not choose insufficient or restricted policy coverage to save premium costs. Instead, consider a comprehensive coverage plan based on the family size, medical history, and financial situation. 3. Hiding health-related details. While purchasing a health insurance plan, disclose all the necessary details about your health, lifestyle habits, and pre-existing diseases. Hiding relevant medical history can cause significant damage, as insurance claims can be rejected based on undisclosed medical information. 4. Not buying a separate health insurance policy. Refrain from relying entirely on medical coverage provided by your employers, as it has only limited coverage. Also, the contract would be terminated immediately after you leave the organization. It is crucial to buy a separate health insurance plan where the quantum of coverage is more, and it will not be affected by the terms and conditions of your current employment. 5. Remember the policy's terms and conditions. Pay attention to the terms and conditions of the policy document. The policy documents state the contract terms, including the coverages, premium costs, renewability conditions, discounts, sublimits, free look period, waiting period, co-payment clause and deductibles. If you still need clarification, you can contact the concerned insurance company for more clarity on your health insurance policy. 6. Buying a policy for just saving tax. Do not buy a health insurance policy to save tax on the premium paid. One should know the tax benefits provided under health insurance premiums paid. Still, purchasing a health insurance plan aims to get sufficient coverage to help you and your family financially during medical and health contingencies. National Health Insurance. National Health Insurance, NHI, sometimes called statutory health insurance, SHI, is a system of health insurance that insures a national population against healthcare costs. The NHI is a social health insurance program, SHIP, that combines the principles of socialism, being one's brother's keeper, with that of insurance, pooling of risks and resources. The public, private, or a combination of both may administer it. The funding mechanisms of NHI vary with the particular program and country. National or statutory health insurance does not equate to government-run or government-financed healthcare but is usually established by national legislation. In some countries, including Australia's Medicare system, the United Kingdom's National Health Service, and South Korea's National Health Insurance Service, contributions to NHI are made via general taxation. Hence, not optional and funded the health system finances. In practice, most people paying for NHI will join it. Where an NHI involves a choice of multiple insurance funds, the rates of contributions may vary, and the person has to choose which insurance fund to belong to. National healthcare insurance programs differ in how the contributions are collected, and services are provided. In countries such as Canada, payment is made by the government directly from tax revenue, and this is known as single-payer healthcare. Services may be provided through publicly or privately owned healthcare providers. In France, a similar system of compulsory contributions is operated, but non-profit organizations administer the collection for NHI purposes. An alternative funding approach is where countries implement national health insurance by legislation requiring compulsory contributions to competing insurance funds. These funds, which may be run by public bodies, private for-profit companies, or private non-profit companies, must provide a minimum standard of coverage and are not allowed to discriminate between patients by charging different rates according to age, occupation, or previous health status, pre-existing medical conditions. To protect the interests of both patients and insurance companies, the government establishes an equalization pool to spread risks between the various funds. The government may also contribute to the equalization pool as a healthcare subsidy. This is the model used in the Netherlands. Contributions by employers and employees to sickness funds primarily fund other countries. These programs' funds come from neither the government nor direct private payments. This system operates in countries such as Germany and Belgium. These funds are usually non-profit institutions run solely for the benefit of their members. These systems are characterized by a mixture of three sources of funds in varying degrees: private, employer-employee contributions, and national and subnational taxes. In addition to direct medical costs, some national insurance plans also provide compensation for loss of work due to ill health, which is part of broader social insurance plans covering pensions, unemployment, occupational retraining, and student financial support. National schemes have the advantage that the pool of contributors tends to be vast and reflects the national population. Healthcare costs tend to be high at the extremes of age and other specific events in life, such as during pregnancy and childbirth. In a national healthcare scheme, these costs are covered by contributions made to the pool over an individual's lifetime, higher when earning capacity is greatest to meet expenses incurred at times when earning capacity is low or non-existent. This differs from private insurance schemes with contribution rates that vary yearly according to health risks, including age, family history, previous illnesses, and the ratio of height to weight. Consequently, some people pay more for their health insurance when they are sick or cannot afford it. These problems do not exist in national health insurance schemes. Objectives of national health insurance. Generally, the objectives of the National Health Insurance Scheme are to 1. Ensure that citizens have access to good healthcare services. 2. Protect families from the financial hardship of huge medical bills. 3. Limit the rise in the cost of healthcare services. 4. Ensure equitable distribution of healthcare costs among different income groups. 5. Ensure a high standard of healthcare delivery to the citizens. 6. Ensure efficiency in healthcare services. 7. Improve and harness private sector participation in healthcare services. 8. Ensure equitable distribution of health facilities within the Federation. 9. Ensure appropriate patronage of levels of healthcare. 10. Ensure the availability of funds to the health sector for improved services. Conclusion. This video has discussed health insurance, its meaning, types, underwriting and benefits. It also discussed the differences between health insurance and life insurance, as well as the difference between health insurance and medical insurance. A health insurance policy is an assurance that provides immediate financial help in case a medical emergency arises. It is a contract between a policyholder and the insurance company that covers medical expenses due to illness, injury or accident. There are two ways by which the insurance company compensate the insured medical expenditures incurred: cashless treatment and reimbursement. There are several health insurance plans. The type of health insurance plan that is the best for an individual would depend on several factors based on specific circumstances. However, health insurance is just an aspect of achieving overall well-being. Maintaining a healthy lifestyle through healthy eating, regular exercise, and stress management is crucial for maintaining good health. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love to hear from you. Please post your comments and questions in the comments section below. If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything's channel, and press the notification button to be notified when new videos are uploaded. Thank you.